Hey guys, welcome back. Today's topic is why markets are not following trends in the economy and why some events trigger market sell-off and why some events, which perhaps obviously should move market, don't do anything. So what is the difference between events that start huge movements on the market between those which don't do basically anything? But before we move on to that topic, I would just like to share performance of my portfolio. Unfortunately, this chart which compares S&P 500 to my portfolio is still not working. So Interactive Brokers, please fix this finally, because I want to visualize how is my portfolio performing compared to S&P 500. But what I do know is that right now I am sitting at around 6% gain year to date. So in the first 2 weeks of this year, my portfolio grew for approximately 6%, while S&P 500 actually went down a little bit. So I'm doing very well. And compared to the last video, as you can see here, my cash position grew for a little bit. And why is that? Well, actually I sold one position and I increased one of my current positions. What did I do actually? As you can see here, I sold 50 stocks of Intel for almost $3,000 and I bought 100 stocks of Dropbox for $2,200. So why did I sell Intel? Well, as you know, Intel will have soon new CEO and markets were thrilled. Intel stocks went up for almost 11% that day. And I simply took advantage of that situation and I sold stocks because I wanted to increase my Dropbox position. Dropbox has cut off its workforce by approximately 11% because most of the people are working from home and will work from home in the future. So they don't need so many people employed right now. So they are basically becoming more efficient and their profit margins will go up because for the same revenue that they will generate, they will need fewer people and they will have fewer expenses, not only in terms of number of employees, but in terms of lease obligations of their real estates. So I saw that as a good thing for investors and good thing for their current and future profits. But all of a sudden market reacted like they did something extremely bad and stocks sold off for more than 6%. But at the other hand, I didn't also want to decrease additionally my cash position, so I had to sell something. And since Intel, as I've already said, went up for almost 11% that day, I simply decided to cut Intel. I think Intel will do good. I don't think at $60 Intel is expensive, but again, I simply had to sell one of my position and yeah, I sold Intel. So let's move on to today's topic. What made me choose today's topic for this video is this headline. Biden's $1.9 trillion COVID relief plan calls for stimulus checks, unemployment support, and much more. This is, of course, a very good thing for the markets. Let's put aside now if this is a good thing for US economy in the long run, for the society in the long run. Let's just put those topics aside and purely from point of view of stock market, this is good thing. And what happened in the markets on those days? Well, basically nothing. Actually, markets went down a little bit in the last 5 days, as you can see on this chart. So a lot of people are again asking themselves, why aren't markets moving on this very good news? Same as many people were asking themselves in March, April, May, and during the summer, why are markets going up when we have millions and millions of people of unemployed? How can that be? Well, the thing with this stimulus check and relief plan, which is worth almost $2 trillion, is that people knew that will happen. We didn't know if it will be 1.5, 1.7 trillion, 1.9 trillion or $2 trillion, but we all basically knew that this stimulus bill is coming. That didn't surprise anybody. It was already priced in the price of the stock. So in order for some news to trigger huge sell-off or huge gains on the markets, it has to be something which we didn't expect. Black swan event or some huge surprise which nobody saw coming. For example, you can see a stock market on this chart in World War I. It of course sold off because nobody expected a world war. That was actually the first time in human history that all world was in war, and consequently markets started selling off because nobody knew what is going to happen soon, how to prepare for this, how long is this war going to last, how impactful is it going to be for example, United States. But as soon as people are starting to see that, for example, war will not come to the US soil, it will mostly be fought in the Europe, and not only that, but European countries actually imported a lot of stuff from US because Europe was in war, and United States was producing a lot of stuff for Europe. Not only that, but the Europeans actually didn't ask for a price because they were desperate. We were desperate during those times, and we were paying no matter what the price was, and actually profit margins for US companies skyrocketed during the World War I. And actually, at the end of the war, stock market was up quite significantly. And during the World War II, unfortunately, I don't have chart for it, but what happened is when it started, US stock market went up because a lot of people expected that a similar thing will happen as it happened in World War I, that United States will export a lot of things. They will be able to increase prices of their goods and services because Europe was a mess and Europe was desperate for products, and stocks started going up. But what happened is that US government made a law that US companies cannot increase prices for Europe and cannot take advantage of situation in Europe. So at the end of the World War II, stocks actually declined significantly. So again, people priced in what they knew. But what happened was a big surprise, which actually triggered buying stocks in World War I and selling stuff in World War II. You can see another thing on this chart. What events triggered the market sell-offs? There are a lot of wars, panics, crashes, crises. As you can see here, height of Cold War and Cuban Missile Crisis, Watergate, etc., etc. So most of these events, almost all of them, actually surprised people. Nobody knew they were coming. When you have, for example, at the beginning of this year, once we had a crash during the March, a lot of people expected millions and millions of unemployed people in next several months. We knew what happened in the economy. We knew we had lockdowns. We knew we had a lot of layoffs in real economy. And those things already were priced in the stock market. That was actually the past. And similar thing happened actually during these days when this stimulus bill went out. A lot of people expected it, so nothing basically happened on the stock markets. If, for example, Biden said, look, it won't be 1.9 trillion as many people expected, it will be $5 trillion, then stocks would go up significantly because that would be a huge surprise. Or same things goes, for example, if Biden would said, no, we are not going to have any relief bill. We won't support the economy anymore because lockdowns are ending soon and there is no need for us to intervene on the markets. We would have huge crash, I assume, on the stock markets because that would be surprised. That wouldn't be priced in the stock market. That wouldn't be something that is basically general assumptions on the investors' minds. So if most of the people are expecting something, no matter if it is good or bad, it probably won't reflect on the markets once that event occurs. What has to happen in order to markets to react on huge upside or downside is that happens something that nobody expects. So if something will move markets higher or lower significantly in this year, again, we don't know right now what is it going to be because it has to surprise us. Hopefully this makes sense to you and this provides you some value so you can expect in the future if some events can move markets significantly. Another thing which comes to my mind is, for example, there are a lot of volatility on stock markets before US elections throughout the history. But do you know what on average is the day when markets bottoms? It's on average 9 days before elections. Because several weeks before elections, uncertainty is at its peak. And that is when markets quite often start to declining because of the uncertainty. But as elections approaches, we actually start to anticipate with high certainty what will happen on the US elections. And approximately 9 days before elections is when markets start bottoming down. Basically, similar thing happened this year. A lot of people expected once we do have elections that markets will sell off because of the uncertainty, panic, etc., etc. But actually markets starting going up approximately a week before the elections. And once we had elections, markets kept going up higher and higher. Again, investors and markets hate uncertainty. As soon as some potential bad or good event becomes certain, becomes obvious, that's when markets will start going up. Because we know what to expect, we know what will approximately happen, and how significant of the impact it will going to have on the stock markets. Thanks for watching and see you next video.